You wake up at 9:28 am. Coffee still brewing, hot and bitter in the mug beside your keyboard. Charts already loaded, glowing in the dim morning light filtering through your blinds. Heart rate climbing with that familiar cocktail of anxiety and electric hope. Today's the day you finally crack the code and bank $500 before your boss even notices you're 5 minutes late to that morning stand-up. Before the first quick sync, message pops up in Slack. Before another day of pretending to care about quarterly projections, while your real focus is on the numbers that actually matter, the ones that could set you free. You've watched the YouTube videos. You've read the Reddit threads. You know the setups. Tesla, Apple, Nvidia, the stocks that move, the stocks that pay. Your watch list is green. Your finger hovers over the buy button. This time will be different. This time you'll catch the move early. This time you'll be the one posting screenshots of your wins while everyone else is trapped in conference rooms discussing synergies and actionable insights. Here's the brutal truth that will save your account from total ruin. 95% of traders lose their entire daily wage in the first hour. Not make it. Let that number sink in, not break even, not make a little. Lose. The opening bell isn't your friend. It's a dinner bell for institutional sharks. And if you don't know exactly what you're doing, you are the meal. The market open is a meat grinder designed to separate amateurs from their money with ruthless efficiency. While you're sitting there, adrenaline pumping, chasing green candles and fighting FOMO, professional traders are doing something that looks insane to the untrained eye. They're sitting in cash. They're watching you. They're waiting for you to donate to their lunch fund. Picture this. Amateur Alex has a $5,000 account. He makes $220 a day at his job. Decent money, but not freedom money. He's watched 10 videos about opening range breakouts and decided that today he becomes a full-time trader. At 9:31, Tesla gaps up $4 on an analyst upgrade. The pre-market looks strong. The chart is a beautiful green rocket ship pointing straight to financial independence. His palms sweat. His breath quickens. The voice in his head screams that the train is leaving the station. I'm missing it, he thinks. Everyone else is getting rich while I sit here like an idiot. He slams the market buy button at $180 with 100 shares. That's $18,000 in notional exposure on a $5,000 account. No defined stop. No plan. Just pure, crystallized hope hitting the market at the worst possible moment. 3 minutes later, the algorithms sweep the liquidity. The stock stalls at $179, then $178. A sudden flush to $176 sends his P&L flashing red. He's down $400 unrealized in minutes, nearly 2 days of his job salary evaporating while he watches, paralyzed. The fear kicks in, cold and sharp. It's crashing. I have to get out. He panic sells at $176, locks in the $400 loss. Then comes the cruelest moment of all. As soon as he sells, the selling pressure dries up. Tesla rips back to $185 without him. By 10 am, Alex has made 4 trades chasing different stocks. He's tried to make it back, doubled his position size on the second trade, scalped pennies, chased another breakout. He's now down $300, more than a day's pay gone before his morning stand-up even starts. He closes the platform in disgust, convinced the problem was the stock, or the news, or the spreads. It wasn't. Professional Sarah sees the exact same Tesla gap. Same news. Same chart. Same opportunity that has Alex salivating. She does nothing, not because she's lazy or scared, because she's surgical. She understands what the opening 30 minutes actually are. A battlefield where emotion meets inventory, where retail panic meets institutional positioning, where people like Alex provide liquidity for people like her. Sarah knows that in the first 15 minutes, volume is massive, but information is low. It's mostly fear and greed hitting the tape, not clear intent. It stops being triggered from overnight positions. It's algorithms forcing wide ranges to test who's really committed. So while Alex is clicking, Sarah is counting. She marks the opening high and low. She watches how far price stretches beyond the range. She notes how fast it snaps back. She's not emotionally attached. She's collecting data. The difference between Alex and Sarah isn't talent. It's not capital. Alex actually started with more money. It's not access to better tools. They use the same broker, same charts, same data feed. The difference is one invisible rule that separates job killers from job prisoners. Professionals don't trade the open. They trade the reaction to the open. Think about what that means. The opening bell is information, not opportunity. It tells you what the overnight crowd thinks, what the headlines are screaming, what the algorithms are programmed to do. But it doesn't tell you what the market actually wants to do today. That only reveals itself after the chaos subsides, after the weak hands have been shaken out, after the emotional trades have been punished. Here's your first maxim. The market pays you to wait, not to chase. This single sentence contains more trading wisdom than most $2,000 courses. The market rewards patience with clarity. It rewards discipline with edge. Every dollar Alex lost was a transfer of wealth from the impatient to the patient, from the reactive to the proactive, from the amateur to the professional. You have to decide right now, are you here to feel the rush of gambling, or are you here to make a living? Because you cannot do both. If you want to replace your salary, you must stop trading like someone desperate to escape their job. Desperation trades the open. Discipline trades the reaction. The amateur looks at the market and asks, how much can I make? The professional asks, how much can I lose? And because the professional refuses to play in the traffic of the opening bell, their risk of ruin drops dramatically. This isn't another get-rich-quick fantasy. This is the opposite. It's the disciplined, boring, systematic approach that makes $500 before lunch possible, not as a miracle, but as a predictable outcome of professional behavior. No secret indicators, no magic algorithms, just structure, patience, and the willingness to do what 95% of traders refuse to do. Wait for your pitch. In the next chapter, you'll discover why the most profitable position you can take at 9:30 am is no position at all, and why that doing nothing will feel harder than any trade you've ever made. Because sitting on your hands while watching the market move without you tests every instinct you have. But it's the only way to survive long enough to thrive. The opening bell hits at exactly 9:30 am Eastern, and it feels like an explosion in your chest. Volume explodes across every ticker on your watch list. Your screen lights up like a Christmas tree on steroids, candles ripping up and down, level 2 data cascading like a waterfall of numbers moving so fast your eyes can barely track the orders. Every fiber of your nervous system screams the same urgent message: trade now. It feels like the train is leaving the station, like money is literally flying through the air, and all you have to do is reach out and grab it. The fear of missing out hits you like a physical blow. You see a stock spike 3% in 10 seconds, and your brain tells you that if you don't click buy this instant, you are throwing away your future. That instinct will bankrupt you faster than any other mistake you can make. Most traders never understand this fundamental truth. Your brain is wired for survival, not for probability. When you see rapid price movement, your survival wiring goes into overdrive. Motion equals threat or opportunity in the primitive brain. A big green candle triggers your fight or flight response. If I don't act, I'll miss out. A big red candle screams, if I don't act, I'll be left holding the bag. This isn't rational analysis. It's prehistoric programming designed to keep you alive in a world of predators and prey. The market knows this. The professionals know this. The algorithms are programmed exactly for this vulnerability. Here's what's really happening in those first 30 minutes, while your heart pounds and your finger twitches over the mouse. Amateur hour. Think of it as the emotional opening ceremony of the trading day. Retail traders who held positions overnight are panicking into exits because gaps went against them. New retail traders are panicking into entries because they're terrified of missing the move. Algorithms programmed by PhDs at hedge funds are systematically hunting stop losses, sweeping liquidity pools, and exploiting the predictable behavior of emotional traders. Market makers are collecting their daily tribute from the unprepared, widening spreads, just enough to catch both sides of every panic move. Professional traders have a name for this phenomenon. They call it the 9:30 trap, because it catches the exact same people every single day, like clockwork. Like a mousetrap that resets itself automatically and never runs out of victims willing to take the cheese. Let me show you the math that explains why this trap is so devastatingly effective. In the first 15 minutes after the bell, The average actively traded stock sees roughly 40% of its entire daily volume. That's nearly half the day's trading compressed into 900 seconds. You'd think that massive volume would represent informed, intelligent money making calculated decisions. You'd be wrong. Studies of order flow show that only about 15% of that opening volume represents what traders call informed trading, institutions with research, hedge funds with models, professionals with edge. The other 85%? Pure, unfiltered emotion. Fear and greed in their rawest, most exploitable form. It's people trading headlines they don't understand. It's algorithms triggering stops that create cascading moves with nothing to do with value. It's overnight gamblers puking out positions at the worst possible prices. When you trade in this environment, you're not investing. You're stepping into a bar fight blindfolded. While Alex is getting absolutely chopped up, making his fourth trade in 20 minutes, each one a desperate attempt to recover from the last, Sarah is doing something that looks almost boring to the untrained eye. She's not leaning forward with her heart pounding. She's leaning back, calm, observing. She's collecting intelligence with the focus of a sniper, waiting for the perfect shot. Sarah opens a notepad and marks key levels on her charts with horizontal lines. She watches which stocks gapped up on news and whether they're holding those gaps or immediately fading. She notes the ones showing unusual volume even in this chaos. She's looking for stocks where buyers keep stepping in at specific prices, where sellers can't push it lower despite trying. She's building a mental map of where the real money is positioning itself once the smoke clears. She's not bored. She's hunting. She knows the market is telling a story, but the first chapter is usually a lie. She's waiting for the plot twist. Here's the protocol that changes everything, the exact time-based framework that separates professionals from gamblers. From 9:30 to 9:45 am, your job is to watch, not trade. This is the hardest 15 minutes of the day, because you must sit there and watch stocks fly without you. Your only task is to mark the high and low of what's called the opening range. These aren't random numbers, they represent the boundaries of the initial emotional reaction. Everything that happens next will be in relation to these levels. From 9:45 to 10:00 am, you look for the first sign of directional conviction. The emotional traders have exhausted themselves. Some have lost and walked away. Others have taken quick profits and stepped aside. Volume starts to normalize. In that normalization, you can finally see what the market actually wants to do. This is where you formulate your thesis. You're not entering yet. You're preparing. From 10:00 to 10:15 am, you wait for the breakout with volume confirmation. This is your window. If you're going to trade, it happens here. You need to see that when price breaks the opening range, it does so with conviction. Volume that's at least 150% of the average. This tells you real money is making a real decision. Sarah spots her setup using this exact timeline. Cis Corporation gapped from 28 to 30.50 cents on earnings. In the first 15 minutes, it spiked to $31, then got hammered by profit takers down to $29.80. That's her opening range, $29.80 to $31. While Alex bought the spike at $30.50 and got stopped out in the flush, Sarah marked her levels and waited. By 9:50, Cis stabilizes around $30. Tight range. Volume drying up. This is the pause before the decision. Then at 10:05 am, something shifts. A large buy order hits the tape. Price reclaims $30.20, then pushes to $30.00, then $30.60. The volume bar is twice the size of the previous bars. This isn't a slow grind. This is conviction. The V-shaped recovery on her chart proves the morning sell-off was a trap. Sarah checks her second data point. S&P 500 futures are up 0.3% and holding steady. The overall market structure is supportive. She's not trying to buy a stock rallying while the entire market tanks. This is confirmation. This is her signal. But here's where amateurs still destroy themselves even when they wait this long. They think any green candle after 10 am is a buy signal. Sarah knows better. She has 3 non-negotiable conditions that must align before she risks a single dollar. These conditions are her filter, her edge, her protection against the market's endless ability to fool you. The difference between a $500 winner and a $300 loser often comes down to whether you have the discipline to demand all 3 conditions, or whether you talk yourself into trading when only two are present. Amateurs negotiate with their rules. Professionals follow them religiously. Patience is not sitting on your couch waiting for something to happen. Patience is active, engaged, disciplined observation. It's the presence of control in an environment designed to make you lose control. When you wait for the 10:00 am window, you're controlling the engagement. You're choosing to fight on your terms, not the market's terms. Patience is not the absence of action. It's the presence of control. In the next chapter, you'll learn Sarah's three-condition filter in complete detail, the exact criteria that turn random market noise into a high-probability $500 setup. Because identifying the time frame is only step one. You still need to know exactly what a winning trade looks like before you pull the trigger. Miss even one condition, and your edge disappears like smoke. Hit all three, and you have something most traders never experience, a genuine statistical advantage. You've waded through the chaos. You survived the opening bell massacre without donating your account to the market makers. The emotional traders have exhausted themselves, and the dust has finally settled. Your heart rate has returned to normal. The tape is readable again, instead of just a blur of panic and greed. Now comes the moment every trader thinks they're ready for, but most will botch completely. The entry. This is where amateurs tell themselves the most dangerous lie in trading: if I just buy strong stocks going up, I'll be fine. Wrong. What separates a professional entry from another amateur disaster isn't the ticker symbol, the headline, or how good the setup looks on first glance. It's three very specific conditions that must align with mathematical precision. Miss even one, and you're gambling with your rent money no matter how confident you feel. Hit all three, and for the first time in your trading career, you actually have a genuine statistical edge. Most traders think up is good, down is bad, and trade accordingly. Professionals think in terms of levels, specific prices where real money made real decisions. Where did buyers step in and defend? Where did sellers attack and succeed? Where did price fail before, and what happens when it comes back to test that battlefield again? These aren't random lines you draw because they look pretty. They are the footprints of institutional money. For XIs, Sarah has already marked her critical level during the morning intelligence gathering, $30.20. This isn't arbitrary. It's where the stock initially tried to hold after gapping higher, where it rolled over under selling pressure, and where it got flushed down to $29.80. It represents the battle line between morning optimists and the sellers who smacked them down. If price can reclaim this level and hold above it with real force, it suggests something important. The buyers are now stronger than the sellers who showed up earlier. But here's where amateurs get slaughtered. They think any move back above a level is bullish. They see three green candles and assume it's time to buy. Sarah knows better. Conviction isn't a slow crawl back to the level with thin volume and indecisive candles that take 15 minutes to gain 20 cents. Conviction is a decisive, violent move back above resistance that happens fast and with institutional force behind it. How do you measure that force? Volume. Sarah demands to see volume that's at least 150% of the 10-minute average. For X's, the average volume per minute during late morning has been around 70,000 shares. When she sees a single green candle at 10:05 am that prints 200,000 shares, nearly 3 times normal, pushing price from 35 cents through $30.20 to $30.35 without hesitation, she knows this isn't retail hope. This is a large fund stepping in and saying, "We're buying here, and we don't care who knows it." Alex sees the same move and thinks, "It's going up. I need in." He doesn't care what level price is reclaiming, how much volume is behind the move, or whether that level has any structural significance. He just sees green and buys. Then he calls it bad luck when his random entries fail at the first sign of resistance. Condition 2. The broader market must cooperate. You are not trading in a vacuum. Every stock is a boat floating on an ocean, and that ocean is the broader market, the S&P 500, the NASDAQ, the sector your stock belongs to. If the tide is going out while you're trying to paddle upstream, you might make some progress, but you're fighting forces much larger than your individual trade. Here's the brutal statistic that changed everything for Sarah. When you fight the overall market trend, your win rate drops by more than 30%. A setup that might have a 70% success rate with market cooperation becomes a 40% coin flip when you're swimming against the current. Is it possible for an individual stock to rally while the S&P tanks? Sure. Does it happen? Occasionally. Is it profitable to bet on consistently? Almost never. Before Sarah even considers hitting the buy button on NYSE, she glances at her S&P 500 futures chart. At 10:05 a.m., she sees the index up 0.3% on the day and holding that gain steadily. No violent whipsaws. No distribution patterns forming. No cracks in the market structure. The broader market is either neutral or supportive of long positions, which means when size pushes higher, it won't be fighting against systematic pressure across all stocks. Professional traders don't fight tides. They ride waves. Sarah only takes the high-probability version of any setup, which means she needs the wind at her back, not in her face. Condition 3. You must have a crystal-clear exit plan before you enter. This is the condition that eliminates more disasters than any other rule in trading. Most amateurs enter a trade and then figure out where to exit. They get in, see red, and freeze. Maybe it will come back. They pray. That's not trading. That's charity work for the market. You must be able to answer 2 questions in under 3 seconds. Where am I wrong? And where am I right? If you can't answer both instantly with specific price levels, you have no business risking real money. Sarah looks at Egg's eyes and defines her battlefield with surgical precision. Entry, $30.25, just above the reclaimed level to ensure the breakout is holding. Stop loss, $29.95, just below the recent higher low and under the psychological $30 level. If price breaks back below here, her reclaimed thesis is dead. Target, $31, near the morning high, but slightly under it to increase her odds of getting filled before earlier buyers bail out. Now she does the math that defines her risk and reward. Risk per share, $30.25 entry minus $29.95 stop equals 30 cents. Reward per share, $31 target minus $30.25 entry equals 75 cents. Risk to reward ratio, 1 to 2.5. For every dollar she risks, she stands to make $2.50. The position sizing formula that saves careers. Here's what truly separates Sarah from Alex. And it's the detail that determines whether you're still trading 6 months from now, or whether you've blown up your account and slunk back to your day job. Position sizing. Alex looks at this setup and thinks, this is the one. I'm going all in. He calculates how many shares his $5,000 account can handle with maximum leverage and throws everything at what feels like a sure thing. Sarah thinks differently. She doesn't think about how much money she has. She thinks about how much money she can afford to lose. Her rule is ironclad. Never risk more than 1% of her account on a single trade. Her account is $15,000. 1% of that is $150. That's her tuition for this lesson. If she's wrong, she pays $150 to learn why, and she still has $14,850 left to trade tomorrow. She survives. The math is simple but profound, and you need to memorize this formula. Position size kelp. Stop distance. Account risk. Sarah's calculation. Account size, $15,000. Risk per trade, 1% kelts, $150. Stop distance, 30 cents. Position size, $150 and cents, 500 shares. It's pure mathematics. It removes emotion from the equation. If her stop distance was wider, say 50 cents, she'd buy fewer shares, 300. If tighter, say 15 cents, she'd buy more shares, $1,000. Her dollar risk never changes, only the share count adjusts. This is how you sleep at night. This is how you trade without your heart exploding. The execution. At 10:07 a.m., all 3 conditions align perfectly. Egg's eyes has reclaimed $30.20 with massive volume. The S&P is supportive. Her exit plan is crystal clear. Sarah enters 500 shares at $30.25. The moment she's filled, she places her stop at $29.95. Her maximum loss is exactly $150. Her target profit is $375. She's not hoping. She's calculating probabilities and managing risk. By 10:38 a.m., Ziz pushes through 30.50 cents, then 30.80 cents. The market cooperation is working in her favor. At 31.10s, slightly above her target, she exits all 500 shares. Her profit, 85 cents per share times 500 shares equals $425. She risked 150 to make 425. That's a realized risk-reward ratio of nearly 1 to 3. Alex, meanwhile, bought 800 shares at 30.30 with no defined stop because this one's a layup. When the stock dipped to $30 after his entry, he panicked and sold at $29.98, right before the real move higher. He turned a controlled opportunity into an emotional wound. The setup isn't about being right. It's about being structured. You can be wrong about direction and still survive if your structure is sound. You can be right about direction and still lose money if your structure is broken. The amateur obsesses over being right. The professional obsesses over structure, because structure is what compounds accounts, while prediction just compounds ego. Sarah didn't predict the future. She didn't know for certain that Egg's eyes would rally. She simply identified a high-probability setup where all three conditions aligned, applied mathematical position sizing, and let probability work in her favor over time. That's not luck. That's professional risk management creating consistent results. But what if you could turn that $425 into $600 or more? What if there was a way to compound winning trades without increasing your risk beyond that original 1%? In the next chapter, you'll learn the pyramiding technique that lets professionals scale into strength, adding to winners in a way that actually reduces total risk rather than increasing it. This is how a good trade becomes a great trade, and how professionals squeeze every dollar of edge from the market when it's handing them money. Sarah is up $425 by 10:38 a.m. One clean trade executed with surgical precision. Her original target of $31 has been hit and exceeded. The stock is still moving higher with purpose. Volume remains strong, and every amateur instinct in her body is screaming the same desperate command: take the money and run. This is the most dangerous psychological crossroads of the entire morning. You see that unrealized profit fluctuating on your screen and feel a desperate need to secure it before it evaporates. You treat that profit like a fragile bird that might fly away if you don't grab it instantly. The voice in your head whispers, you never go broke taking a profit, and don't be greedy. This feels like discipline, but it's actually fear disguised as prudence. Every professional instinct says something completely different. This is where the real money begins. Here's the fundamental DNA difference that separates traders who make a living from traders who make excuses. Amateurs scale into weakness. Professionals scale into strength. Think about what most losing traders do when a position moves against them. They bought at $30, it drops to $29, and they think, it's cheaper now, I should buy more and average down my cost basis. This is the most seductive death trap in trading. You're rewarding a stock that's proving you wrong, throwing good money after bad, and transforming a manageable loss into a catastrophic one. Sarah does the exact opposite. She only gives more capital to trades that have already proven they deserve it. This is called pyramiding, and when done correctly, it's the technique that transforms good traders into great ones. Watch precisely how she navigates this moment. Instead of exiting her entire 500-share position, Sarah executes a controlled partial exit. She sells 300 shares at $31.10, banking $285 in realized profit. That money is now locked in her account, untouchable, already deposited. This single action does something profound to her psychology. It removes the fear of loss from the equation. She keeps the remaining 200 shares as a free ride, but she doesn't leave them exposed to the original risk. She immediately moves her stop loss from $29.95 up to $30.80, well above her original entry price of $30.25. Think about the position she's engineered. She has $285 in realized profit. If XI's collapses instantly and hits her new stop at $30.80, she'll make an additional $110 on those 200 shares, $30.80.25, 55 cents 200 shares. Her absolute worst-case scenario is walking away with $395 profit. She has created a situation where she cannot lose. The trade can only pay her more or pay her slightly less than the maximum possible, but it cannot hurt her. At 11:00 a.m., Egg's Eyes pushes through 31.30 cents with expanding volume. This isn't the thin, exhausted buying that signals a top. This is fresh institutional accumulation. A second wave of buyers is stepping in with conviction. The market is not just proving her thesis correct, it's accelerating the proof with expanding participation. This is where most traders would just watch and hope. Sarah gets aggressive in a calculated way. She adds 300 shares at $31.35. To the amateur, this looks insane. Why buy at $31.35 when you could have bought at $30.25? You're ruining your average price. Sarah doesn't care about her average price. She cares about her risk exposure relative to her potential reward. Here's the mathematical brilliance of what she's done. She now controls 500 shares again, 200 from her original entry and 300 fresh shares. But her stop loss for all 500 shares remains at $30.80. Let's calculate her new risk profile. Risk analysis on the pyramid. Original 200 shares entry $30.25, stop $30.80, guaranteed profit of 55 cents per share, plus 110. New 300 shares, entry $31.5, stop $30.80, potential loss of 55 cents per share plus $165. Net risk if stopped out, $165 loss, minus $110 profit, no $55 total risk. Already banked profit, $285 untrading. She's controlling $15,675 worth of stock with only $55 of net risk beyond her already secured profits. She's using the market's own money to leverage her position against itself. This isn't gambling. This is mathematical edge amplification. At 11:15, AMEGS hits $32.10. The move is becoming extended, and Sarah recognizes the signs of a parabolic climax. She exits everything. All 500 shares at $32.10. Final profit calculation. Previously banked, 300 shares sold at $31.10 from $30.25's entry $285. Original 200 shares, $32.10, $30.25, $30.70. Added 300 shares, $32.10, $35. Total profit, $25. She turned a $425 winner into a $595 winner, a 40% increase in profit, by pyramiding into strength rather than taking profits too early. She didn't increase her original dollar risk. She used the market's confirmation to compound her position size while maintaining strict risk control. The 3 pyramiding rules that prevent disaster. Rule 1. Only add when price moves away from your entry in your favor. The market must be proving you right with both price and volume before you commit additional capital. Rule 2. Only add when you can raise your stop to reduce total risk. Every pyramid addition should lower your net dollar risk through higher protective stops, not increase it. Rule 3. Never pyramid into a loser, ever. Averaging down is rewarding failure. Pyramiding is rewarding proof. This isn't greed. Greed is wanting money you haven't earned. This is mathematical edge amplification, using the market's own momentum to compound your position while the market pays you to take the additional risk. When the market screams you are right, the professional response isn't to run away. It's to listen and back that confirmation with calculated additional capital. Pyramiding is rewarding proof, not chasing hope. When amateurs add to positions, they're usually chasing hope, hoping a loser comes back, hoping they can recover losses faster. When professionals pyramid, they're rewarding mathematical proof. The market just confirmed their thesis with price, volume, and momentum, so they allocate more capital to what's demonstrably working. Sarah is now sitting on $595 of profit before 11:20 a.m. She's crushed her $500 daily target by nearly 20%. The market is still open, still moving, still flashing opportunities across her screen. The dopamine is hitting her brain like a drug. And this brings us to the most psychologically difficult moment of the entire trading day. Most traders destroy themselves right here. They don't know when to stop. They give back morning profits in afternoon chop, turning job-killing days into break-even disappointments. In the next chapter, you'll discover why the most profitable decision Sarah makes all day happens at exactly 11:20 a.m., and why walking away while ahead is the ultimate display of professional power. It's 11:20 a.m. Sarah's trading platform displays a bright green number that would make most people's hearts race, plus $595. Her original daily target was $500. She's exceeded it by nearly 20% in less than 2 hours of focused work. The market is still wide open, still moving, still flashing opportunities across her multiple monitors. Her scanner is pinging with fresh momentum plays. Volume spikes are lighting up her watch list like a Christmas tree. The dopamine is coursing through her system from the morning's winning trades, and every instinct in her trader's brain is screaming the same seductive message: you're hot today. Keep going. And right here, in this exact moment of triumph and possibility, is where 90% of traders systematically destroy themselves. They keep trading. The amateur logic feels perfectly rational in the heat of the moment. It whispers in your own voice, using your own dreams against you. I'm in the zone today. I'm seeing the market clearly. My reads are perfect. If I made $595 in 2 hours, imagine what I could make by market close. I could double this. I could turn this into a $1,200 day. This could be the day that changes everything. So they keep clicking. They take another trade at 11:45 a.m. that goes sideways, and they scratch out for break-even. They spot what looks like another perfect setup at 12:30 p.m., but it moves against them, and they take a small loss. Now they're frustrated and want to make it back, so they force a trade at 1:15 p.m. that violates every rule they followed perfectly in the morning. The position whipsaws them for another loss. By 2 p.m. they're tilting. By 2:45 p.m. they're revenge trading. By 3 p.m., they've given back $400 from their morning high. By the 4 p.m. closing bell, they're sitting at plus 195 for the day, still technically green, but having surrendered 67% of their morning profits to the afternoon grinder. Meet Mark, our amateur counterpart to Sarah. Same morning setup, same kind of winning start, but without the same rules. By Friday, after repeating this pattern of morning profits and afternoon losses throughout the week, his entire week ends up flat or barely green. The job killer he dreamed about on Monday morning has quietly transformed into just another job requirement, another source of stress, another thing he has to show up for every day without the freedom he was desperately seeking. Sarah does something at 11:20 a.m. that looks like weakness to untrained eyes, but requires tremendous psychological strength. She closes her trading platform entirely. She stops. Not because she's tired, she's energized and confident. Not because she's scared of losing, she's riding a wave of success. Not because she can't find more setups, her scanners are showing several promising candidates. She stops because she understands something that most traders never learn: the invisible mathematics of intraday volatility and how the risk-reward equation deteriorates dramatically as the day progresses. Here's what Sarah knows from brutal experience and meticulous data collection. The highest quality intraday moves happen in the first 90 minutes after the market settles from opening chaos. From roughly 10:00 a.m. to 11:30 a.m. Eastern, you get the clearest directional conviction, the deepest liquidity, and the strongest institutional participation. This is when real money makes real decisions after evaluating overnight information and morning price action. This is when genuine trends establish themselves with conviction and volume. After 11:30 a.m., the entire character of the market undergoes a structural transformation. Volume typically drops by 60% or more as institutional traders step away from active positioning. The big money has already executed their primary orders for the day. What remains is mostly algorithmic chop, retail traders fighting over scraps, and professionals who are now managing existing positions rather than initiating fresh ones. Bid-ask spreads widen because market makers know there's less volume to hide behind. Price action becomes choppier, more random, more prone to false breakouts, and sudden reversals that have nothing to do with underlying value or trend. The algorithms themselves change behavior patterns. The same systems that were trend following in the morning switch to mean reversion modes in the afternoon. A breakout that would have ripped $3 higher at 10:00 and now fakes out buyers and reverses $2 at 1:00 p.m. The mathematical edge that existed in the morning has evaporated. Sarah didn't learn this from a book or a YouTube video. She proved it to herself through painful experience and systematic analysis. She conducted a comprehensive audit of her previous 100 trading days, meticulously tagging every single trade by time of day and analyzing the results. The data was undeniable and shocking. On days when she stopped trading after hitting her target before 11:30 a.m., her win rate was an impressive 78%. Nearly 8 out of 10 trades were profitable, and the winners significantly outweighed the losers in dollar terms. Her average profit on these disciplined days was $520, and more importantly, she kept those profits. On days when she continued trading past noon, trying to maximize her opportunities or stay engaged with the market, her win rate collapsed to just 43%, worse than flipping a coin. Her average profit on those extended days was only $280, despite trading for 6 additional hours. She was working 3 times longer to make half the money, with twice the stress and significantly worse statistics. The afternoon wasn't just less profitable, it was actively stealing her morning edge. This revelation led Sarah to develop what she calls the protocol. It's a binary rule set that allows for zero negotiation or emotional override. Rule 1. Daily profit target is $500. Rule 2. Daily stop loss is $200. Rule 3. Hit either number, and the trading day is immediately over. No exceptions. No just one more trade, because this setup looks perfect. Sarah's target was $500. She made $595. At 11:20 a.m., her workday is officially finished. She doesn't just minimize her trading platform, she shuts down the software entirely. She walks away from the desk. She goes to the gym while other traders are doom-scrolling through lunchtime chop. She meets a friend for coffee, while others are revenge trading their morning profits away. She reads, learns, rests, and recharges her mental energy so she can return tomorrow with fresh focus and discipline. This is the real job killer that the title promises, and it's not what most people expect. It's not about making money fast or getting rich quick. It's about the freedom that comes from making money efficiently and systematically. While other traders chain themselves to screens for 8, 10, or 12 hours a day, grinding out mediocre returns while slowly destroying their mental health, Sarah works one intensely focused hour and walks away with professional results, and her entire day still available to live. The mathematics of consistency. Let's examine what disciplined execution actually produces over time, because this is where the get-rich-quick mentality dies and real wealth building begins. Daily target, Sex 500. Trading days per week, 4. Weekly profit, 5,004, 2,000. Trading weeks per year, 50. For holidays and vacation. Annual profit, 2,050, 100,000. Now for the time investment analysis. Sarah trades approximately 1.5 hours per day when you include pre-market preparation and post-trade analysis, 4 days per week. That's 6 hours per week of total trading-related work. Over 50 weeks, that's 300 hours annually to generate $100,000. Effective rate, 300 hours, $100,000. Clocks 333 per hour. Compare this to a traditional corporate job paying $100,000 annually that requires 50-plus hours per week including commute and overtime. That's 2,500-plus hours per year for the same income. An effective rate of $40 per hour, with no control over schedule, no ability to stop when you've won, and no upside for exceptional performance. Sarah's approach delivers not just comparable income, but superior lifestyle freedom and time leverage. The beauty of this system isn't the individual $500 days, it's the compound effect of consistency. Most amateur traders chase the $2,000 home run days and ignore the steady base hits. But $500 per day, executed with boring discipline, creates more wealth and freedom than sporadic big wins followed by devastating losses. The trader who can stop is richer than the trader who can't. This maxim contains more practical wisdom than most expensive trading courses. Wealth isn't just about making money, it's about keeping money and having the freedom to enjoy it. The trader who makes $1,000 in the morning but gives back $700 in the afternoon isn't richer than the trader who makes $500 and walks away. The trader who generates $200,000 annually but spends 80 hours per week stressed and glued to screens isn't richer than the trader who makes $100,000 working 6 focused hours per week with complete schedule control. The ability to stop when ahead represents the ultimate display of professional discipline. It's proof that you're trading to build a life, not to feed an addiction. It's proof that you understand the mathematics of edge and how it deteriorates throughout the day. Most importantly, it's proof that you have genuine confidence in your system. Because if you truly believe you can make $500 tomorrow using the same process, you don't need to risk today's profits chasing more. At 11:20 a.m., Sarah chooses discipline over dopamine. She accepts that she will miss afternoon moves. She understands that walking away is part of her edge, not a limitation of it. She trades her need for constant action for something far more valuable, a consistently rising equity curve, and a life outside the screen. In our final chapter, You'll receive the complete protocol laid out step by step, your executable roadmap for making $500 before lunch without giving it back by dinner. Every time block will be defined. Every decision point will be clarified. Every rule that separates professionals from perpetual strugglers will be revealed. It's time to transform this knowledge into your daily trading reality. You started this journey with a simple, almost dangerous question burning in your mind. Can I really make $500 before lunch? Maybe part of you hoped for a secret indicator, a hidden algorithm, or some mystical pattern that would unlock fast money. But if you've stayed with me to this point, you understand the deeper truth. The job killer was never a trick or a hack. It's a protocol, a systematic approach to the market that looks almost boring from the outside, but feels powerfully controlled from the inside. Now we close every loop and hand you the complete roadmap. Not theory, not concepts. Your executable blueprint for tomorrow morning when you sit down at your trading platform. This protocol has been tested, refined, and proven. Print it out. Tape it to your monitor. Follow it with religious discipline until executing these steps becomes as automatic as breathing. The protocol divides your morning into 4 precise phases, each with specific objectives and non-negotiable rules. Deviation from this timeline transforms you from a professional trader into a gambler, regardless of how the market moves. Phase 1, 9:30 am to 9:45 am intelligence gathering. When that opening bell hits, you become a detective, not a participant. Your hands stay away from the buy and sell buttons. This is a physical rule as much as a mental one. If you need to, remove your hand from the mouse entirely. During these 15 critical minutes, you are collecting battlefield intelligence while everyone else is bleeding out in no man's land. Your first task is marking the opening range highs and lows on every stock in your watch list. These aren't random lines you draw because they look pretty. They represent the boundaries of the initial emotional reaction and will serve as your reference points for everything that follows. For a stock like Eggs's, you might mark a high at $31 and a low at $29.80. Those two numbers become your map. Note which stocks are holding their pre-market gaps versus which ones immediately fade. A stock that gaps up 3% on earnings news but holds that gap through the first 10 minutes of chaos is telling you something important. Real institutional buyers are defending that level. A stock that gaps up 3% but immediately sells off toward flat is screaming the opposite message. The gap was retail bait, and smart money is distributing into the enthusiasm. Watch volume patterns with laser focus. Is the volume front-loaded with a massive spike in the first 5 minutes followed by silence? Or do you see sustained, consistent participation throughout the entire 15-minute window? Sustained volume suggests genuine institutional involvement. Front-loaded volume followed by a vacuum suggests emotional retail traders who will soon find themselves trapped. The hardest part of this phase is psychological. You will watch stocks rip 5, 7, even 10% in minutes. Your FOMO will be screaming. Your palms will sweat. The voice in your head will insist you're missing the opportunity of a lifetime. You must do nothing. You are feeding your edge, not your impulses. Professionals don't trade the chaos. They trade the reaction to the chaos. Phase 2, 9:45 am to 10:15 am setup identification. The emotional traders have exhausted themselves. The opening range is established. The market is beginning to show you its true intentions. Now you shift into active hunting mode, but with surgical precision. You're looking for stocks that demonstrate all 3 non-negotiable conditions we established earlier. First, price must reclaim a key level with absolute conviction. Not a slow, tired crawl back above a line, but a decisive, violent move on volume that's at least 150% of the 10-minute average. This is institutional money making a statement, not retail hope creeping higher. Second, the broader market must cooperate. Check your S&P 500 futures, your NASDAQ futures, and if relevant, the sector at CF. You don't need perfect alignment, but you cannot be swimming upstream against a powerful current and expect consistent success. Third, you must have a crystal-clear exit plan before you risk a single dollar. Know your stop-loss level, where your thesis is objectively wrong, not where it feels comfortable. Know your profit target, a logical level like a prior high, measured move, or psychological resistance that gives you at least a 1 to 2 risk-reward ratio. Only when all three conditions align do you calculate position size using the formula that has saved more trading careers than any other rule. Position size STEC. Stop distance. Account risk, 1%. If your account is $15,000, your maximum risk per trade is $150. If your stop distance is 30 cents, you buy 500 shares. If your stop distance is 50 cents, you buy 300 shares. The mathematics removes emotion from sizing decisions and ensures you survive inevitable losing streaks. Enter only when all three conditions align perfectly. Not 2 out of 3. Not close enough because this setup looks so good. All three conditions. Or you wait for the next opportunity. Professional traders are comfortable missing moves because they understand that forced trades destroy accounts faster than any market crash. Phase 3, 10-15 AM to $11 AM trade management. You've entered a position that met all your criteria. Now you execute the profit-taking and risk reduction strategy that separates professionals from amateurs. When price reaches your first target, immediately take partial profits on 60 to 70% of your position. This accomplishes two critical objectives. It locks in realized gains that can never be taken away, and it removes the psychological fear that causes traders to exit winners too early. Move your stop to break even on the remaining shares. You've now engineered a free ride, where your worst-case scenario is a small profit instead of a loss. The trade can only pay you more, or pay you slightly less, but it cannot hurt you. If the stock continues moving in your favor with expanding volume, consider pyramiding, adding fresh capital to your winner while raising your stop to maintain or reduce total risk. But follow the ironclad rule: only pyramid into strength, never into weakness. Only add when price is proving you right with conviction, and only when you can raise stops to protect the new capital. Never, under any circumstances, add to a losing position. Averaging down is the amateur's path to catastrophic losses. Pyramiding into strength is the professional's path to amplified gains. Phase 4, $11 AM and beyond the discipline. This is where most traders fail, and where you will prove you're different. You have two numbers written on a sticky note attached to your monitor: your daily profit target of $500 and your maximum daily loss of $200. Hit your target? Close your platform immediately. Hit your stop loss? Close your platform immediately. The amateur logic of "I'm so close to my target, just one more trade, or I need to make back what I lost," is the voice of addiction masquerading as strategy. Professionals have rules and follow them without negotiation or emotional override. Here's the identity shift that changes everything and determines whether you're still trading profitably 6 months from now. Amateurs trade to feel productive. Professionals trade to compound capital. Amateurs measure success by activity: how many trades they made, how many hours they watched charts, how busy they felt. Professionals measure success by results: what they kept at the end of the week, not what they made and gave back throughout the day. You can sit in front of charts for 12 hours and feel like you worked hard while your account bleeds money. Or you can execute one perfect trade in 90 minutes and bank $500. Which trader are you? Sarah's real results after 6 months. These aren't hypothetical projections. This is what systematic discipline produces when applied consistently. Average daily profit, $487. Win rate, 74%. Average time invested, 1.2 hours per day. Days per week traded, 4. Annual projection, $95,000. Let's verify the mathematics of this approach. Daily profit, $500. Weekly profit, 5,004 days, $2,000. Annual profits, 2,050 weeks, $100,000 / day 4 days, 50 weeks, 240 hours year. Effective rate, 240 hours, $100,000, 417 per hour. This isn't about getting rich overnight. It's about building a systematic approach that generates professional-level income with complete schedule control and minimal time investment. Your 4 pillars. Memorize these. First, wait for confirmation, not chaos. The market rewards patience with clarity. Trade the reaction to the open, never the open itself. Second, risk exactly what you can afford to lose. 1% per trade, calculated mathematically, with no exceptions for sure things. Third, scale into strength, never weakness. Reward proof with additional capital. Cut losses without hesitation. Fourth, stop when your goal is achieved. The trader who can walk away is richer than the trader who can't. These 4 pillars are your foundation. Build every trading decision on top of them, and your account will compound. Violate them chasing quick money, and you'll join the 95% who lose. Cut losses fast. Size small. Wait for confirmation. Own your process. This maxim contains the entire philosophy in 8 words. Cut losses fast means respecting your stops without hesitation or hope. Size small means risking 1%, not gambling with position sizes that can destroy you. Wait for confirmation means trading the reaction, not the chaos. Own your process means taking responsibility for your decisions and following your rules regardless of short-term outcomes. The job killer isn't about speed or market prediction. It's about structure, patience, and the discipline to execute what most traders know but refuse to do consistently. You wait for your edge, you execute with mathematical precision, and you walk away when you've won. If you want to scale this foundation from $500 days to $2,000 days, if you want to understand the advanced mechanics of institutional order flow and how the biggest players move size through markets without showing their hand, the next lesson will reveal exactly how you can position yourself ahead of their moves before the retail crowd even knows what's happening. But master this protocol first. Prove to yourself that you can execute these rules consistently before adding complexity. The roadmap is complete. The system is proven. The only variable left is your discipline. Tomorrow morning at 9:30 a.m., you know exactly what to do. Now, execute.